Welcome back to the channel, everyone. Today I want to talk about how the SEC has finally issued some charges for AMC manipulation. I want to talk about why this is a brilliant step in the right direction and what I think is still to come. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, the SEC has charged TradeZero America and its co-founder with deceiving customers about meme stock trading halts. It says the SEC has charged broker-dealer TradeZero America and its co-founder with falsely stating to the firm's customers that they didn't restrict the customers' purchases of meme stocks when in fact they did. It says TradeZero was instructed by its clearing broker, which obviously was Apex, not to allow its customers to purchase 3 meme stocks. TradeZero ultimately halted purchases for about 10 minutes. After the halt, TradeZero and Piptone made misleading public statements via interviews, social media, and in a press release in an effort to distinguish their company from brokers that restricted trading during that period. Now, obviously, as I'm sure you all know, halting the purchasing of AMC, even only for 10 minutes, was still more than enough to cause enough damage to effectively stop the AMC and GameStop squeezes in their tracks. And the SEC said this case sends a powerful message that participants in our capital markets cannot exploit market turbulence to deceive customers. The SEC has been committed to ensuring that our capital markets continue to function in times of uncertainty, and today's actions highlight that commitment. Now, I want to talk about why this is good for the AMC movement, but again, why this on its own isn't enough just yet. Now, the main charges that the SEC have issued here are the fact that this broker, and obviously its co-founder, deceived retail investors and tried to generate new business by setting itself apart from other brokers. They've basically turned around to retail investors and said, guys, don't sign up to Robinhood, don't sign up to Webull, and don't sign up to TD Ameritrade. Sign up with us because we don't turn off the buy button. When obviously in reality that was false, because they did turn off the buy button for about 10 minutes and then tried to claim the whole time that they never did such a thing. Now, this broker isn't being charged with turning off the buy button or any of the other illegalities around that. They're only being charged with trying to acquire new customers based on false information. But why this is a good step in the right direction is that it shows the SEC is still investigating meme stocks and everything that happened back in late January. Again, it shows the SEC isn't afraid to dig a little deeper and figure out exactly what happened back in January of 2021 when the meme stocks did indeed run up. And it also shows the SEC isn't afraid to issue charges based on what happened with the meme stocks. And as I said, I don't think the SEC is done yet. The SEC has been uncovering waves upon waves upon waves of market manipulation over the last few weeks specifically, especially around Archegos Capital Management and Bill Hwang. We know that Bill Hwang is talking to the SEC and the Department of Justice, and again, we also know the SEC and the Department of Justice aren't shying away from future investigations, and they have promised to continue bringing down the hammer. And therefore, by adding 2 and 2 together, the SEC and the Department of Justice are going to continue issuing new charges and imposing more severe sentences, like actual jail sentences, and are still investigating meme stocks and exactly what happened back in January. And therefore, I expect more and more and more charges to come over the next few weeks, the next few months, as a result of what happened back in January of 2021. And therefore, I do think overall this is a step in the right direction. It isn't quite the charges that we want just yet, but I do think we're well on the way to seeing future charges over the next few weeks. Guys, today I want to give a massive shout out to the sponsor of today's video, Coin Telegraph Markets Pro, which I believe is the #1 platform for crypto analytics. Markets Pro has its very own algorithm, Vortex, which is not a prediction of how asset prices will change over time, but an analysis of how asset prices have changed historically when faced with market conditions similar to current ones. This powerful AI is operating 24/7, signaling when it might be a good time to look at that asset based on historical patterns. Markets Pro also provides newsquake alerts, which are important news headlines that have historically moved the prices of assets. The newsquake's algorithm scans thousands of sources every second for market moving information. Some of these newsquakes will even alert you before the news hits Twitter, potentially helping you get into a trade before the masses. You can also create a watch list for your crypto portfolio or favourite assets. You can even scan for coins that have unusual Twitter activity, unusual trading volume, or large price changes. You even get a newsfeed curated to all of the assets you want to follow. Coin Telegraph also has its own Markets Pro Discord where the community share strategies, have 24/7 support, and participate in AMAs with industry leading experts. So be sure to sign up to Coin Telegraph Markets Pro using the link in the description below, and also use the code Thomas at checkout for $20 off of any subscription package. And I also wanted to talk about the wider market. But Ackman has tweeted saying inflation is out of control. Inflation expectations are getting out of control. Markets are imploding because investors are not confident that the Fed will stop inflation. If the Fed doesn't do its job, the markets will do the Fed's job for them. And that's what's happening right now. Obviously, the Fed should be trying to curb inflation by raising interest rates, but if the Fed doesn't raise interest rates fast enough, the market will crash, and that will effectively reduce inflation due to a crashing market. And therefore, if the Fed doesn't do its job fast enough by raising interest rates, the market will effectively do the job for the Fed by just crashing. Bill says the only way to stop today's raging inflation is with aggressive monetary tightening or with a collapse in the economy. And he said with today's unprecedented job openings, a 3.6% unemployment rate, long-term supply and demand imbalances in energy, agriculture and food, housing and labour, and with the wage price spiral that is underway, there is no prospect for a material reduction in inflation unless the Fed aggressively raises rates or the stock market crashes. He said in the last day or so, various current and former Fed members have waffled and made dovish remarks proposing a modest increase in rates and a pause in the fall. The Fed has already lost credibility for its misread and late pivot on inflation, and there is no economic precedent for 200 to 300 basis points of Fed funds addressing 8% inflation with unemployment at 3.6%. He's basically saying the Fed aren't acting quick enough. He said they're not raising rates fast enough, and they've also changed their mind and pivoted on inflation far too late. And again, they're still not doing anything to catch up on that late pivot. And he says, how does this downward market spiral end? He said it ends when the Fed puts a line in the sand on inflation and says it will do whatever it takes, but then also demonstrates it seriously by immediately raising rates to neutral or committing to do so. And obviously Michael Burry also agrees. He says, as I said about 2008, it's like watching a plane crash. It hurts, it's not fun, and I'm not smiling. Michael Burry also knows the Fed haven't reacted quick enough to raise rates, and they didn't pivot fast enough on inflation, and they're not doing enough to catch up. And that is why the market is still falling and will continue to fall over the next few weeks and the next few months until the Fed actually do something to catch up with inflation. But again, these tremors and these spirals aren't just being felt in the stock market. Unusual Whales tweeted saying new home sales have plunged by 16.6% to a seasonally adjusted annual rate of 591,000 units last month. So that's down from a consensus estimate of 750,000 new home sales, and last month where we saw 790,000 new home sales. Both of those have obviously fallen down to 591,000. That's obviously a massive fall in new home sales, and it says it's the lowest month since April of 2020, aka when the pandemic was at full flare and when the entire world was locked down and practically no sales were actually happening. But even though sales of new homes have fallen by 16.6% to the lowest rate since deep in the pandemic, house prices in the US rose by nearly 20%. This is just showing the clear differential and the clear difference between supply and demand, or the difference between actual house prices and actual house sales. House prices are still rising at record rates, but yet very few homes are actually being sold, and actually they're decreasing significantly. I think everybody obviously realizes just how crazy house prices are at the moment. And not only that, but they also can't afford new house prices considering inflation and the cost of living is going up. Now, one country that is supposedly ready to again raise interest rates is the UK. The Bank of England are prepared to raise interest rates again, says Bailey. He said, "We've raised the official rate 4 times so far and have made clear that in order to bring inflation down to target, we're prepared to do so again based on the assessment at each of our meetings." But obviously, again, the UK have been so slow to react and so slow to actually increase rates. Rates so far have been increased from 0.1% up to 1%, but again, the current UK inflation rate is around 9%, so even higher than in the US. And there's some claims currently circling that I think have really hit the nail on the head. Some are accusing the Bank of England of stoking inflation by letting demand get out of hand in response to the pandemic. During the pandemic, demand for everything was going up and up and up, and the UK and the Bank of England did absolutely nothing to try and curb that demand because they thought increasing demand during the pandemic was a good thing. Now, obviously, keeping the wheel turning during the pandemic was a good thing, but at the same time, it's caused inflation to spin wildly out of control, and now prices everywhere have been rapidly increasing. Mervyn King, who was the bank's governor back in 2008 when financial markets crashed, said the Bank of England's actions during the pandemic actually helped push inflation to 40-year highs. I think this is something that really applies to both the UK and the US, because at the same time, demand was spiralling also in the US, but the Fed did nothing to try and curb it. Now, obviously, the Fed has reacted far too late to these current inflation worries, and that's why inflation is so out of control, but still the rates aren't being raised fast enough. This is only going to continue to compound the current market crash and also to compound this plunge in new home sales, because inflation is still going to be increasing as rates aren't being raised fast enough, and therefore homes are going to continue getting more expensive, but more and more people won't be able to afford them. And this won't be resolved until the market continues its crash and effectively bottoms out when some of those big players or some of those largest institutions end up being liquidated. So guys, be sure to leave a comment down below and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.